very likely somebody's going to end up wrong-footed here very soon. And when big, powerful financial institutions get wrong-footed, that's when you can have really, really ugly losses. And they can come on very quickly. And my guess is we're probably going to see some very, very jaw-dropping moves in our financial space in the very, very near future. We have a number of challenges confronting us. On the financial/economic front, it's a big pile of issues that are all coming to a head all at the same time. Whether it's this virus/vaccine and the response to it all, or whether it's our tree-hugging friends who want to destroy our economy and destroy supply chains. We've got some very, very tough days in front of us right now. And how it all works out, I don't know. But my gut feeling tells me you're going to be best prepared if you've got some storable food and if you've got some dollar-unfriendly investments under your belt. And whether that is precious metal or whether that is cryptocurrency, I think you're going to do well with both at the end of the day.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs. Welcome back to Liberty and Finance. We have a returning guest who is wildly popular with our viewers. Rob Kirby is a proprietary analyst and the founder of KirbyAnalytics.com. He joins us this Friday, November 12th, 2021. Rob, thanks for coming back on.
Wonderful to be with you again, Dunnigan.
When we last spoke a little over a month ago, you cautioned us, as you have in the past sometimes, that you see striking volatility ahead and increased risk for the U.S. dollar, the financial edifice. You said you see hard times ahead. People are concerned about that. It seems in greater and greater number. I speak with many clients every week who are first-time metals buyers because they are losing any remaining confidence that they had in our government, in our in our banks, in our Fed, in our U.S. dollar, etc., and they're seeking safe haven. One of the things you mentioned in that is dollar alternatives, and you talked about the potential that cryptocurrencies could be serving as an alternative to the U.S. dollar for settlement, for example, of petroleum transactions. There's a question here from a viewer, Stone881, who says, Mr. Kirby, you have suggested in recent months that crypto is being used to settle global trade, and with ever-increasing reports of energy deals between sanctioned nations, assuming non-U.S. dollar settlement, do you have further evidence to support your thesis, and what does this mean for the U.S. dollar and gold in the near term?
Okay, well, let me explain to you the nature of my thesis about cryptocurrencies de facto being used in settlement of international trade accounts. It goes something like this. We have, in terms of dollar volume, ever increasing on a daily basis. If you look at, as long as you're taking like a week or a 2-week average, the amount of dollars in crypto form or dollar equivalents that are trading in crypto form on a daily basis is growing over time. And, the data that I look at shows me that if you take a 2-week running average, you've got crypto transactions occurring on a daily 24-hour rolling basis of close to 150 billion a day. So if you annualize that, you've got over 50 trillion in crypto transactions on an annualized basis occurring right now. And what I'm saying, there's only one way you can get to $50 trillion in crypto transactions, and that is necessarily has to involve trade settlement, because you don't get to a 50 trillion annualized number. You buying Bitcoin from me, taking it out of your left pocket and putting it into your right pocket. While money has been debased in a severe way, 50 trillion still buys a lot of love in this world. And 50 trillion is a massive number, and we're talking easily numbers that big, or more. So, and the comparison that I've tried to make with you in the past, and it goes back to saying to somebody, if I ask you to think of something that weighs thousands of pounds, that's gray and has a trunk and big floppy ears and a tail, there's only one thing in the world that can be. Okay? Now, just as I don't have to mention what that is, because everybody knows what that is, on the same hand, you can't have $50 trillion worth of dollar equivalent worth of transactions unless you're settling trade accounts, because it doesn't fit any other way. So that's what it is. And if people don't want to accept it, what it really comes down to, Dunnigan, it's basically, if you talk about religion, some people have faith and believe in religion, and you don't really have to show them a whole lot of evidence that there is, a divine entity in the world. And so some people, you don't need to show them anything. Other people, it wouldn't matter what you showed them. They would never believe that there's a divine entity. And those people are called atheists. So if people want to bring their atheism into settling financial issues, then so be it. I'm not going to be one of them. I understand that with the amount of crypto that's trading, there absolutely is trade settlement occurring, and that's good enough for me. And it's not a leap to say what I'm saying. It's factual.
The second half of the question is, what is your interpretation of the take on what that implies about the future of the U.S. dollar and gold?
Well, these crypto volumes keep getting bigger, and as the crypto volumes continue to get bigger, the prospects for the dollar continue to get muddier or uglier. And where we're getting to is we're building to a point. One of your opening remarks was concerning volatility. A great harbinger of massive, possibly paradigm shift or something very, very large about to happen. An article that was published on Zero Hedge in the last 24 hours spoke about Goldman Sachs being gobsmacked with the volume of equity options that are trading. Specifically, I think they referenced last Friday. I believe the number in the headline in the article was that Goldman was absolutely shocked with the volume of equity options that traded. I believe it was the number they threw out was $2.6 trillion worth. It was either in a day or in a couple of days. But, I mean, let's put it this way. For Goldman Sachs to be shocked at the volume of equity options trading, that tells me, that to me is a siren call that somebody somewhere is expecting huge paradigm shift type change coming in the very, very near future. To have that amount of speculation occurring, that is not mom and pops taking a pot shot at something. 2.6 trillion is big money. That is big, even in notional terms. That's big money. To be happening in a day or two or three, that's crazy. And these are bets. These are bets. That's like somebody walking into a casino and putting 25 million on black or on red and saying, let's roll. Like, that's crazy stuff. And you know what? You can ignore the signals or what that might be purporting or what that might be tending to suggest is coming in the very near future or not. I mean, it's irrelevant to me whether people want to look at those signs. It's like when you see a really, really dark cloud, a really, really dark cloud, at the end of a really, really hot day in the middle of summer, and to walk out and say, only an idiot would take an umbrella with them. It might be a good time to stay indoors. Like, that's the kind of weather that brings you hail and tornadoes and crazy stuff. I would suggest to you 2.6 trillion in options trading in equities is the equivalent of a very, very dark thundercloud. And, the exact meaning of it, Dunnigan, the meaning of excessive volume of trade in equity options, and to have it be big enough that it sort of rocks Goldman Sachs's world, it tells me that Goldman Sachs probably wasn't anticipating a number that big. And I find it also, I'm curious about if Goldman Sachs wasn't expecting it, maybe they weren't part of that particular line of trade. And that tells me that very likely somebody's going to end up wrong-footed here very soon. And when big, powerful financial institutions get wrong-footed, that's when you can have really, really ugly losses. And they can come on very quickly. And my guess is we're probably going to see some very, very jaw-dropping moves in our financial space in the very, very near future. And I don't know. Listen, I think that the prospects of a full-blown hyperinflation, which we're basically seeing early signs of now, we could hyperinflate, and the stock market conceivably, possibly could double from here very quickly. It could also have a resounding collapse. It really depends on where the central bankers are inclined to take us. My feeling is that they're going to hyperinflate. And when they hyperinflate, because I think it's a foregone conclusion that they will do it, but when they do, the banks are not going to want to extend credit to people, which in my mind means that the mortgage market will dry up. And the reasoning for that, because there are people who will say, well, you're not being consistent in your thinking here. If we're going to hyperinflate, the banks are not going to want to extend credit to people today if they truly believe they're going to be repaid in tragically debased dollars. I don't want to lend somebody $20 million to do a commercial real estate deal today if I think they're going to be paying me back with 2 bags of confetti in 5 years or in 3 years or maybe in 6 months. So hyperinflations are not the sort of thing that make finance operate. It's sort of like throwing sand in the gears of everything financial.
Right.
And gears don't work well when they've got sand.
You brought this up, and I really want to key in on it, the mortgage dilemma, because I think a lot of people have been glad for record low interest rates on mortgage, making homes more within reach for some people, that people being able to sell their homes and enjoy significant nominal gains on those, that sort of thing. But these record low rates, they've started to inch up recently, and the qualifications for mortgages have not become bubble territory, like throwing out any of the credit checks like happened at the end of in 2007, that kind of thing. Alistair McLeod has talked to us about banks pulling in their horns. And that's been a question that's been nagging at me, is what kind of risk are ordinary people who are taking on large mortgages facing at this point if the mortgage contract can include terms that say that, on the decease of one of the co-signers, if it's a husband-wife, for example, that are taking out the mortgage, that the bank can deem the loan payable in full, that sort of thing. If the banks aren't willing to take on the kind of risk, as you're saying, if the banks start perceiving risky times ahead, then what kind of exposure do ordinary mortgage holders have as the mortgage pays?
If the population starts to thin out the way I believe it will, real estate is going to be offered and there won't be a bid. And that's what I think we're staring down the barrel of right now. And I think that's coming to a theater near you real soon. In the meantime, even if that is a complete non-event and non-issue, we still have the issue that too much money is being printed, and we are hyperinflating, or we're seeing the early signs of hyperinflation now. Look at the price of crude oil, look at the price of groceries, and all of this seems to be, at least in my view, planned. I mean, why are there 120 some odd container ships sitting off ports along the west coast of the United States of America? Why? Like, there's no good reason. I mean, there are reasons, but there's no good reason why this should have occurred now, unless it was planned. Unless it was planned, unless they basically threatened people. Dock workers have been threatened if they're not vaccinated, they don't have their jobs. Truck drivers have been threatened with losing their jobs if they're not vaccinated. We have issues in California where there's an environmental board in California which imposed regulations on the ports in California where trucks built before, I believe it was 2014, any truck built before 2014 was not allowed to service a port in California. You know what that did to the availability of trucks to do work in California? I mean, the number of trucks that exist in California, I think the fleet is something like 150,000 trucks. It's an enormous number. But the number of trucks that are in the fleets in California that are built after 2014, there's only 5,000 of them. And 5,000 trucks wouldn't service one port. And how many major ports are there in California? I mean, we've, LA, San Diego, Oakland. There's a lot of them. So this has all been done by plan. This is because on the environmental front, they've put people who are extremely politically oriented towards the left, who are tree huggers, who think it's a good idea to shut down the economy, and who want to move us all this stuff about zero carbon. Just remember this, everybody. When they talk about zero carbon, remember you are made of carbon. So zero carbon means zero people, and zero carbon means zero food. And eliminating CO2, you know what plants eat? Their food is CO2. And what they expel is oxygen. And they want to get rid of trees. These people are stark, raving lunatics. And they want to shut humanity down. And it's a cult, and it's crazy, and it's sick. But in any case, we have a number of challenges confronting us. On the financial/economic front, it's a big pile of issues that are all coming to a head all at the same time. Whether it's this virus/vaccine and the response to it all, or whether it's our tree hugging friends who want to destroy our economy and destroy supply chains, we've got some very, very tough days in front of us right now. And how it all works out, I don't know. But my gut feeling tells me you're going to be best prepared if you've got some storable food and if you've got some dollar unfriendly investments under your belt. And whether that is precious metal or whether that is cryptocurrency, I think you're going to do well with both at the end of the day. And I've long been on record saying, in the last couple of years anyway, that the anti-dollar trades are going to do great, but they're going to be led by cryptos. And that sure seems to be what has been occurring. And metals will get their day in the sun too. But the problem with the metals, now what's going on with the metals is as follows. Like, people look at the price of Bitcoin, the price of Ethereum and cryptocurrencies, and they say, these things are going up like crazy. Should I sell all my metal and get all into crypto? And my attitude is no, but conceivably, if you're holding both, you might want to, if you're going to put new money in, or I guess it really depends on how much you have or how much exposure you have to each. I think you should have some exposure to both. But my feeling regarding the metals is that we have a regulatory problem with metals. I've had people suggest to me or say to me, we need new laws for metals. And I don't think we need new laws at all. What we do need is to have existing laws actually enforced. There are commodities laws that state that the type of activity that's occurring in metals technically is not legal. And we have regulators in place, supposedly to be the ombudsman for little guy and to prevent heavy concentration of shorts and manipulative practices. But because the government is the entity doing the manipulating, government agencies are not going to call out the people who sign their paychecks. So as a result, we have undeniable massive fraud occurring in the precious metal space. And so, necessity being the mother of all invention, cryptocurrencies have taken off. And I would have it that Bitcoin is only behaving the way gold should, but is prevented from doing. So in that respect, Bitcoin has really performed more of a surrogate function than necessarily, in the beginning anyway, being the go-to thing. It's evolved into being a bit of a go-to thing now because the metals have been basically, I'm going to say, freeze-dried or frozen in space because regulators refuse or have refused to date to do their job. So what am I really saying here? Does that mean I don't like metals? No, not at all. I think metals are still a great place. And they're a dark horse underdog. They serve a function much more like life insurance. You know, you buy life insurance hoping not to collect. Most people do anyway. Life insurance is a legacy type thing. And precious metal, physical precious metal, I think serves somewhat of that function currently. But what I do believe comes as we get into increasing financial distress on a sovereign level, the regulatory regimes that are currently in place, in my view, at some point will be swept away. And that is the thing that I'm basically on the lookout for, is a crack in the current regime of regulatory affairs as it pertains to oversight over commodities and precious metals in particular, because metals will have their day in the sun, but when they do, none will be for sale. They will be revalued and marked up dramatically. And you will either own them and experience it for the good, or you will have missed the train and you will not get on the train because the train will have left the station. So that's where I think we are, and that's where I think we're headed. And you have to be pre-positioned. Unfortunately, with metal, you must be pre-positioned, and you got to hold physical metal.
In regards to a potential crack up of or a change to the regulatory mechanism or the methods that are used to set the price on these major commercial exchanges today, there have been significant eyes looking towards the end of the year and Basel III net stable funds requirements coming into effect. Your view of whether that is likely to produce itself any noticeable change in the behavior of pricing on the major metal exchanges?
Well, my view about Basel III is that it's only Basel III and the legislative change is only an acknowledgement by the powers that be that basically it's an acknowledgement that metals A have been suppressed and that B, they will resume their position as a very, very formidable monetary asset in the future. So it's sort of like do as I say, not as I do, because what these powers that be are doing, on one hand, they're suppressing the paper price of metal, and on the other hand, they're passing legislation that arbitrarily mean that physical metal will have tremendous value at some point in the future. That's what that means to me. So, ignore their paper games, own some physical, and sit on it. And it's unfortunately because of the position we're in, where regulators don't regulate. But I mean, how long is the regulation, or how long is the current regulatory regime going to last? I would answer that question with another question. How long do you think Joe Biden is going to be president of the United States? Have you heard him speak lately? Don't think he's going to be there a lot longer. Did you hear Nancy Pelosi dress him down yesterday? And his administration? Boy, sure sounds like Nancy Pelosi. She gave the old Joe Biden regime a dressing down like I've never seen in my life. Sounds like Nancy Pelosi's trying to distance herself from this debacle of a mistake. But that's where we are. And you see, that fits well with this whole thing I was talking about Goldman Sachs being gobsmacked with all this volume in the equity options market. I'm telling you, that's a harbinger that there is something real big coming.
Another question that came around, is this another big thing? Is this another harbinger? Sarge27271 asks, Rob, how does Rob see Evergrande bond debacle affecting us? Is it going to go through Deutsche Bank first because they're the largest derivative holder out there?
Boy, my personal belief is that Evergrande is probably being made a much bigger event than it really is. Okay, and I love it when people try to refer to. If I had $1 for every time people said or vocalized, they talk about Evergrande as being the Lehman moment. What is a Lehman moment? What is a Lehman moment? People have tried to ascribe Lehman for some reason to being the symbol of the financial market meltdown in 2007 through 9. And Lehman really is no more relevant to what happened back then as, the 61st candle on my birthday cake on my last birthday. It's irrelevant because the Lehman moment really wasn't about Lehman. The Lehman moment was about a complete and utter destruction of our credit markets. I mean, we had, you see, what spawned the Lehman moment? What spawned the Lehman moment wasn't Lehman. What spawned the Lehman moment was Bear Stearns. And the fact that regulators who don't regulate in the precious metals arena at all, they decided to enforce the regulations on Bear Stearns. Because Bear Stearns had a whole bunch of mortgage-backed securities, subprime mortgages, that were repackaged. This is like taking 3 coilers that come out of the backside of a dog, putting them in a bag and rating it AAA. And you see what happened when they did this at Bear Stearns. And understand, Bear Stearns was not the only one doing this. Bear Stearns was the one they decided to call out because Bear Stearns had some bad history in their trunk. Okay, Bear Stearns didn't want to play with the team back in 1998 in the long-term capital crisis because the boys at Bear Stearns knew that there was a big gold issue with the long-term capital debacle. And they were livid when they were being told by the likes of Jim Rickards and Alan Greenspan that they had to take a big haircut. And you see, through Bear Stearns' eyes, it was like, you guys are telling us we have to take a big haircut because you guys were screwing around in the gold market. And we don't like that. So come 2007, when Bear Stearns had a whole bunch of non-performing subprime loans, they decided to basically bankrupt Bear Stearns, and they wound them into J.P. Morgan. Like J.P. Morgan, I believe, bought Bear Stearns for $1, like for nothing. But what they did get to inherit from Bear Stearns was a huge metals long, and it reduced the size of J.P. Morgan's short. And you can see that reflected in their gold position as it's posted on the Office of the Comptroller of the Currency's quarterly derivatives reports. It's there in black and white. So anybody who thinks that Bear Stearns was wrong having a whole bunch of mortgage-backed securities, subprime mortgage-backed securities on their books, well, let's just say Goldman Sachs had as much or more. Merrill Lynch had as much or more. Merrill Lynch was forced into a marriage with Bank of America. Goldman Sachs was bailed out through insurance contracts that they had, whether they were actually written beforehand or whether they just got created out of thin air. But Goldman Sachs basically was rescued by AIG. AIG did not have the financial wherewithal to really bail out Goldman Sachs's issue. And so AIG got a huge injection of cash. I mean, and a lot of that cash was to actually prevent Goldman Sachs from failing the same way that Bear Stearns did. I mean, along came Lehman at the end of this whole debacle, but they were the icing on the icing on the icing on the cake. But everyone thinks that this is what typifies. You see, but what really happened, I said it was a credit event. What happens when you have trillions of dollars or hundreds and hundreds and hundreds of billions of mortgage-backed securities that should be rated junk, okay, because that's what they were. They were junk. They were worse than junk. They were actually a letter that begins with S and ends in T. And these things were rated AAA. People should have gone to jail for that. And what happens when AAA bonds fail is the whole world goes topsy-turvy. Our commercial paper markets all trade on credit. Our commercial paper markets are the lifeblood of our economy. And what happens when people don't trust AAA anymore, people refuse to buy corporate paper. Corporate paper is the lifeblood of our economy. And you see, commercial paper all trades on credit rating. And AAA is supposed to be, and up until that point in time, AAA credit means it was unassailable. AAA credit had never failed in the history of credit markets until 2007. You see, and there are some people who would say, well, what about Michael Milken? Well, Michael Milken was dealing in junk. Michael Milken never bought or sold anything rated AAA. He was dealing in D and C, non-investment grade paper. But when you take something that's a steaming three-coiler and you call it AAA and then it fails, people then say, why would I even want to buy a government bond? They're rated AAA too. And what does AAA mean anymore when AAA fails? Anyway, and that was, to me, this whole thing about talking about the financial crisis of 2007 through 9, calling it the Lehman event, is complete and utter purposeful misdirection on the part of monetary authorities, because monetary authorities don't want to admit how bad they screwed up. They allowed those credit rating agencies, the Moody's, the S&Ps, the Fitches of the world, they allowed them to rate this stuff, which was worse than crap that comes out of the back end of a dock. They were allowed to rate it AAA. And that's fraud. That is serious, serious fraud. And the people that did that should have gone to jail. But you know what? No one went to jail. No one went to jail. And they conveniently slough it off, calling it the Lehman event. Lehman event, my behind. It had nothing to do with Lehman. It had everything to do with fraud perpetrated on humanity on a level we've never seen in the financial universe ever. And it continues today.
In the light of that, and thank you for that history lesson, always illuminating, why do you say that Evergrande you don't think will amount to a sea change moment in the credit markets?
What's 300 billion these days is really my question. I mean, what's 300 billion? 300 billion when the Fed is growing their balance sheet by 5 trillion in a year? Do you think that's a big issue? What about the five plus trillion that the Fed strapped onto their balance sheet in the last year? Most of which, of course, is mortgage bonds too, and government bonds. And isn't it amazing? Isn't it amazing that through this financial crisis that people refer to as the Lehman event, we had the Fed go into a serious bout of quantitative easing where they're buying bonds like banshees. Do you know that the Fed buys, when they buy mortgage-backed securities, they buy them at par with government securities? Do you think that mortgage-backed securities should trade at par with U.S. government securities? There are some people who would say, well, they are guaranteed by Freddie and Fannie Mae, and so they carry this sort of quasi-government guarantee. So maybe they should, or maybe they shouldn't. Do you think that the bonds held by do you think that the bonds that failed, that were held by Bear Stearns, do you think they should trade at par with government securities, with 5-year government bonds? I don't think so. One failed, and the other one is still making payments. How much longer the U.S. government continues to make payments, I don't know. I mean, my belief is they'll print the money and keep making the payments. The question is whether the payments they make will buy you a cup of coffee at some point in the future. I don't know. So, just remember, we had a country once upon a time, well, it still exists, Zimbabwe. The Zimbabwe dollar, I believe, as recently as 1990, I believe it traded around 90 cents American. And when their currency went off the blocks, basically became a non-issued currency, I believe in 2008-ish or thereabouts. In 18 years, if you had 6 $100 trillion Zimbabwe banknotes, you could buy 3 eggs. for 600 trillion Zimbabwe dollars. And in 1990, a Zimbabwe dollar was worth around 90 cents. And that's what happens in a real inflation. And that's where America's headed right now with their dollar. And the prospects for that dollar going forward are not good. The prospects for the alternatives, which are precious metal, which are cryptocurrency, I think their prospects on a relative basis look very good. But it's all relative. So where do you want to put your eggs?
In that light, you mentioned earlier physical precious metals. We have a question from Lesos Gaming who says, why is it better to own physical precious metals versus paper forms of precious metals? And in what scenario would it be better to own physical metals versus paper?
The issue here you're talking about, or you should be thinking about, is counterparty risk. Let's put it this way. Even if you have a lot of money, and if we enter a period of stiff hyperinflation, I expect capital controls to be imposed by banks. So, or by central banks. So if let's think about it this way. If you have $2 million in the bank, you think you're set for life, probably. You think you're not going to have cash problems. But what happens when the government says, or when the banking community says, we don't care how much you have in the bank, we're only going to give you access to $500 a week. What if you got a mortgage? What if you have a mortgage of $5,000 a month? And you think you have all the money in the bank, you think you're going to be able to pay your mortgage no problem at $5,000 a month. But along comes the new capital control, and they say you can now have $500 a week. Well, that's $2,000 a month. Well, guess what? Try paying a $5,000 mortgage with $2,000 if that's all they let you have. And, there's a history of countries who've had problems with their currency where they've imposed capital controls, which is why I don't want to have that counterparty risk, the third-party risk. I don't want to have my assets. I don't want anyone between me and my assets. When I'm talking about having physical metal, I'm talking about literally taking ownership of bars and or coins and dealing with where I hide them myself, not putting them in a safety deposit box in a bank. Maybe I dig a hole in the back garden. Maybe that's where I keep it. Maybe I keep it in a secret place only known to me and my most trusted, confidence. But what we're talking about here, the issue is eliminating counterparty risk. And when you own paper, what paper gold is a promise of gold. Okay? And how good is somebody's promise if they become bankrupt? What happens when you have a futures contract from COMEX and COMEX becomes insolvent and you're told, okay, you have a piece of paper saying you're entitled to this, but we have a very, very long list of people who have claims on a limited amount of gold because every ounce that they have in their inventory, they've sold about 300 times. So you can have your piece of paper that says COMEX owes you X number of ounces of gold or silver. But if they tell you to get at the back of the line and wait for your turn, it might be very much like in the old Soviet Union when you went to the grocery store and you lined up for 3 hours to get a loaf of bread. And by the time you get to the front of the line, there's no bread left. And, with the socialist mindset of our rulers today and the way that we're headed, no shock will come to me if the people who've got promises of metal in paper form get in the proverbial line and find out when they get to the front of the line, they say, "Oh, well, we just gave our last few ounces away. We'll give you some fiat money instead. We're going to give you 6 $100 trillion Zimbabwe banknotes."
I was wondering when that was going to rear its head again.
Okay, so there you go. You can go buy 3 eggs, but you get no gold. Have a nice day. And we're going to call it square now.
Yeah, I know we're almost out of time, but we have a closely related question, so I want to squeak this in. Eli says, given today's market and economic situation, how do you favor stacking more cheaper generic rounds of metals versus government-backed, more expensive coins? Any opinion about that?
My opinion about bullion is buy it as cheap as you can get it, because what you're in it for is the big how are you, and the spread between look, sovereign metal coins carry a premium over generic. There is a differentiation. Okay, in today's market, it's small, generally speaking, pretty small. I would say even if it becomes substantial, there will come a time where it'll be meaningless. You see, at the end of the day, if gold goes to $100,000 an ounce, which I think it could, people in the melt bins, you will find just as many at gold 100,000 an ounce. You'll find just as many numismatic coins as you will bullion coins when it gets there. So at the end of the day, you want to buy bullion as cheap as you can. So whatever's the cheapest, like if you can buy junk silver,
pre-65,
yeah, and if you can buy that stuff at a cheaper rate per ounce than sovereign coin, be it Eagles or Maples or Philharmonics, then go for it. If you can buy jewelry at a cheap enough price, I'd say, when I buy bullion, I want to get the most bullion I can for my dollar, plain and simple. So that's what I believe in. Buy cheap, buy often.
For people who want to stay connected with you more often than your visits here, where should they stay plugged in?
At KirbyAnalytics.com, and find places like Finance and Liberty and other locations around the net. I pop up every now and then.
And folks, so that you don't miss a single interview with Rob or any of our guests, make sure that you go to libertyandfinance.com, put in your name, email address, click submit, and then confirm with a confirming email. You'll get every one of our interviews, a link to it, a description, any of the resources or links that our guests provide will be included in that, so that you won't miss a single episode or a single guest, including any of Rob Kirby's. So Rob Kirby, founder of KirbyAnalytics.com, thanks for joining us again here on Liberty and Finance.
Been my pleasure. Happy Thanksgiving a little early.
Thank you. You too. This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price, with personalized private service from one of the oldest and best companies in the business. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs.